Welcome back to the Know Your Dough Show, your favorite FDIC-inspired video series on everything you need to know finance. Today, we're going to be talking about credit and how it can trap you or save you.
Credit can be defined as borrowing money to purchase goods and services when you need them, rather than saving and waiting to make a purchase. Essentially, when you borrow money on credit, you are receiving a loan.
So credit is often used for many types of loans, including student loans, home loans, or getting through emergencies. Depending on the circumstance, you might use a credit card, a student loan, a home loan, a mortgage, etc. But they all have one thing in common. They're usually used as a short-term means that is almost of a semi-investment. You're willing to pay the extra interest for the ease of access to credit so you can spend on a whim.
While credit can allow you to buy a house, a car, or other things when you need them, if you overspend, you may find yourself in debt that you cannot repay.
So, this actually brings us to another important point, creditworthiness. So, banks aren't just going to let you take credit whenever you want on a whim. They want to make sure that they're going to get their money back first. And creditworthiness is actually how they dictate whether or not you are trustable for them to give you credit. Because it's always going to be a risk when they're lending you money.
To evaluate your creditworthiness, lenders often look at your credit report, which shows who you are, your debt, whether or not you make payments on time, etc. This credit report is also used to produce a credit score, which lenders will look at to determine if you are likely to pay your loan off in time or not. This number is usually from 350 to 800, with a low number meaning you are a risky investment, but a high number meaning that you are a fairly safe investment.
So your credit score is not an end-all be-all. It's not always going to stay the same. It can be improved or made worse depending on how financially responsible you are over a given period of time, and it's regularly updated. So it's important to stay as financially responsible and be up to date with payments or loans as possible so your credit score stays high. Otherwise, for example, it might be hard to even get a car loan, for example. Many dealerships will look at your credit score and might actually reject your application and not even let you buy a car from them if your credit score is too low. And the same goes for renting a house, getting a mortgage, etc. So it's really important to try to make sure you have as good as credit as possible. Now, I will say there are actual ways to keep track of your credit score without paying. There's things such as you'll see on TV a lot, creditkarma.com and other credit score searching services that you can either pay or not pay for, and it's really important because you want to actually know what your real credit score is.
Negative credit history usually means that an individual is late when making payments, frequently makes credit applications, and maxes out limits on credit cards. But a positive credit history means an individual is usually consistent, reasonable, and responsible.
Hopefully you have a good idea what credit and creditworthiness both are. Thank you so much today for coming back and watching another episode of the Know Your Dough Show. Make sure to like, comment, and subscribe. Please interact with us. This has been Landon
and Ava,
and we're here to make sure that you know your dough.